Effective communication of internal control deficiencies is an essential responsibility of external auditors and an important contribution to sound corporate governance. Although the primary objective of an external audit is to express an opinion on the financial statements rather than evaluate the effectiveness of internal control, ACCA 265 communicating deficiencies in internal control to those charged with governance and management requires auditors to communicate significant deficiencies identified during the audit on a timely basis. Such communication assists management and those charged with governance in strengthening internal control systems, reducing the risk of fraud and error, improving operational efficiency, and enhancing the reliability of financial reporting. By reporting control weaknesses together with practical recommendations, auditors add value beyond the statutory audit function while supporting the organization's risk management and governance framework. During the audit, auditors assess the design and implementation of controls relevant to financial reporting and may identify deficiencies where controls are missing, inadequately designed, or fail to operate effectively. A control deficiency exists when a control does not prevent, detect, or correct material misstatements on a timely basis, while a significant deficiency is a deficiency or combination of deficiencies that, in the auditor's professional judgment, is sufficiently important to merit the attention of those charged with governance. The significance of a deficiency depends upon factors including the likelihood of material misstatement, the importance of the affected financial statement area, the susceptibility to fraud, the volume of transactions involved, and the effectiveness of compensating controls. Significant deficiencies require formal communication because they may expose the entity to increased financial reporting risk and governance weaknesses. Communication of internal control deficiencies should occur as soon as practicable after the auditor identifies matters requiring attention. Significant deficiencies are normally communicated in writing to those charged with governance, such as the audit committee or board of directors, while less significant deficiencies may be communicated orally or in writing to appropriate levels of management. Formal communication often takes the form of a management letter, issued following completion of the audit, which summarizes identified weaknesses together with recommendations for improvement. The management letter does not constitute a qualification of the audit opinion, but provides constructive observations intended to strengthen governance, internal control, and operational effectiveness. Timely communication enables management to implement corrective actions before weaknesses result in material misstatements or operational losses. The management letter should present deficiencies in a clear and structured format that facilitates understanding and corrective action. Each finding should describe the control weakness identified, explain the potential implications or risks arising from the deficiency, and provide practical recommendations for improvement. For example, where inadequate segregation of duties exists within the purchasing function, the report should explain that a single employee performing authorization, recording, and payment functions increases the risk of fraud or unauthorized expenditure. The accompanying recommendation may propose segregation of purchasing, recording, and payment responsibilities together with independent supervisory review of supplier payments. By linking weaknesses to their associated risks and corrective actions, management letters provide valuable guidance for strengthening internal controls. Common internal control deficiencies frequently reported by auditors include inadequate segregation of duties, absence of authorization procedures, poor physical security over assets, failure to perform reconciliations, unrestricted access to accounting systems, weak password controls, inadequate review of journal entries, and insufficient monitoring of key controls. In each case, auditors should recommend controls that are practical, cost-effective, and proportionate to the identified risks. Recommendations may include introducing independent reconciliations, strengthening authorization procedures, implementing automated system controls, restricting user access rights, improving documentation standards, enhancing staff training, establishing internal audit reviews, or introducing periodic management monitoring. The objective is to reduce the likelihood of fraud, error, and financial misstatement while improving operational efficiency and governance effectiveness. Auditors should avoid assuming management responsibilities when communicating internal control deficiencies. Their role is to identify weaknesses and recommend improvements, rather than design or implement control systems. Management remains responsible for establishing and maintaining effective internal controls, allocating resources, implementing recommendations, and monitoring ongoing effectiveness. This distinction preserves auditor independence while ensuring that governance responsibilities remain with those charged with directing the organization. Auditors may discuss alternative control solutions with management but should not participate directly in implementing controls that could subsequently become subject to audit review, thereby avoiding self-review threats to independence. Communication with those charged with governance extends beyond reporting internal control deficiencies and forms an essential aspect of the audit process under ACCA 260 communication with those charged with governance. Regular communication promotes transparency, accountability, and effective oversight of financial reporting by facilitating two-way dialogue between auditors and the governing body. Matters commonly communicated include the planned scope and timing of the audit, significant audit risks, materiality judgments, accounting policies, significant accounting estimates, uncorrected misstatements, difficulties encountered during the audit, auditor independence, and significant deficiencies in internal control. Such communication enables those charged with governance to fulfill their oversight responsibilities and supports informed decision-making regarding financial reporting and risk management. The Audit Committee often serves as the principal channel through which communication occurs between external auditors and the Board of Directors. Through regular meetings and written reports, auditors provide independent observations regarding financial reporting quality, internal controls, fraud risks, and governance processes. Effective communication enhances the Audit Committee's ability to challenge management, monitor internal controls, oversee external and internal audit functions, and promote ethical corporate behavior. It also strengthens investor confidence by demonstrating that governance structures actively monitor financial reporting integrity and respond appropriately to identified weaknesses. Ultimately, effective communication regarding internal control deficiencies contributes significantly to audit quality and corporate governance. By identifying significant weaknesses, explaining their potential consequences, recommending practical improvements, and maintaining constructive dialogue with management and those charged with governance, auditors support continuous improvement in internal control systems while preserving their independence and professional objectivity. This communication process enhances financial reporting reliability, strengthens organizational accountability, reduces business risk, and reinforces public confidence in the audit profession and the integrity of corporate financial information.